It's one of those good problems to have, but it's still a real head-scratcher. You come into a chunk of money, maybe it's an inheritance, a big bonus, or you sold something, and now you're faced with a question. What is the absolute smartest way to get this money into the market? Do you just rip the Band-Aid off and invest it all at once? Or do you ease in, little by little? Okay, let's make this real. Imagine you have $100,000 sitting in your bank account right now. What do? Option 1, you invest the whole shebang today. That's what we call lump sum investing. Option 2, you spread it out, maybe $10,000 a month for the next 10 months. One feels kind of bold, right? The other feels, well, safer. But which one is actually better for your wallet? Now, most people, their gut feeling immediately pulls them towards that second option. It just feels less risky, more in control. And this strategy has a name you've probably heard a million times: dollar cost averaging.
At its heart, dollar cost averaging, or DCA, is all about taking the stress of timing the market completely off the table. The idea is simple. You invest a fixed amount of money on a regular schedule, let's say the first of every month, and you do it no matter what the market is doing. It's a disciplined, almost automatic way to invest.
And setting it up is incredibly simple. Seriously, you just pick what you want to invest in, decide how much to invest over time, and break that into smaller, regular chunks. Then, and this is the key part, you automate it, set it, and forget it. The whole point is to take your emotions and second-guessing out of the picture. So here's where the magic really happens. Let's look at this example with Bitcoin. By investing the same $500 every month, your money automatically buys more Bitcoin when the price is low, like it was in December, and it buys less when the price is high, like back in January. What's the result? You get a smoothed-out average purchase price that can be way lower than if you had the bad luck of investing everything at the peak. So you can see why DCA is so popular, right? It's both practical and psychological. It's super simple, it builds a great habit of consistent investing, and most importantly, it protects us from that nightmare scenario of putting all our money in right before a huge market crash. It's a strategy designed to help you sleep at night. Okay, so case closed. DCA is the logical, safer, smarter choice, right? Well, this is where things get really interesting, because the data, it tells a very, very different story.
Because while our intuition, our gut, tells us that easing in is the safer play, decades of historical market data paint a surprisingly different picture.
75%. A massive study by Northwestern Mutual looked at market data all the way back to 1950, and what they found was kind of shocking. Investing a lump sum in a 100% stock portfolio gave you a higher return than dollar cost averaging, a staggering 75% of the time. We're talking 3 out of every 4 times. So why? Why does this happen? Well, it boils down to one of the oldest things in investing. Time in the market beats timing the market. See, over the long run, markets tend to go up. By keeping your money on the sidelines with DCA, you're basically making a bet that the market is about to drop. But history shows you're way more likely to just miss out on days when the market goes up.
And this chart really brings it to life. The line in the middle, at 0, is the break-even point. Now look all the way to the far left. You can see those few times where DCA worked out and saved investors from a big drop. But now, look at that huge mountain of outcomes to the right of 0. Most of the time, lump sum investing doesn't just win, it wins by a lot.
And here's the real kicker. You'd think DCA would be better for more cautious investors, right? Nope. For a more conservative portfolio, like 60% stocks and 40% bonds, the advantage of a lump sum investment actually increases. It outperforms DCA 80% of the time. The data is just overwhelming.
So this creates a fascinating paradox. If the math so clearly, so overwhelmingly favors investing all at once, why is dollar cost averaging still so incredibly popular? Well, the answer has less to do with finance and a lot more to do with human psychology.
It all comes down to a powerful cognitive bias called loss aversion. Behavioral economists have proven that for our brains, the pain of losing $100 feels about twice as bad as the pleasure of gaining $100. We are literally hardwired to avoid losses, even if it means we miss out on potential gains. This quote just nails it perfectly. When you invest your whole lump sum, that's an active decision. You pull the trigger. If the market tanks the next day, that feels like a personal failure, and the regret is intense. But with DCA, you're holding back. If the market soars while your cash is on the sidelines, yeah, you might be a little bummed out, but the psychological pain is nowhere near as sharp. So you see, the choice isn't just about spreadsheets and historical returns. It's about managing your own emotions. It's a battle between the mathematically optimal choice and the choice that protects you from the powerful feeling of regret. All right, so how do we square this circle? We've got hard data on one side and our very human emotions on the other. How do you actually make a decision that's right for you? It really boils down to this one simple trade-off. Are you trying to maximize your returns, or are you trying to minimize your regret? On one side, lump sum investing gives you the best statistical shot at the biggest long-term gains. On the other side, dollar-cost averaging smooths out the journey and makes it psychologically easier to handle.
So which one fits you? Well, if you have a long time horizon, you can handle some ups and downs without panicking, and your main goal is growth, the data says lump sum is your best bet. But if market swings make you super anxious, or you just want a simple, disciplined plan you don't have to think about, DCA is a fantastic strategy. Because at the end of the day, the best investment plan is the one you can actually stick with.
And that's really the question to have to ask yourself. There is no single right answer here. There's only the right answer for you. So is your strategy built to squeeze out every last drop of potential return, or is it built to let you sleep peacefully at night? Your answer to that question will tell you everything you need to know.